Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Podcast. We are live. We have a special guest for you. We're going to introduce him in just a second. We have a lot to unpack tonight, a lot to talk about. The Fed is going to make a big announcement this week as to whether they raise interest rates, keep them where they are, or drop it. He's got a lot of pressure on him. I would not want to be Jay Powell. The banking industry has really turned upside down as well. It has a lot of people wondering if their money is safe. We're going to talk about that tonight. We're going to talk about the history, a little bit of history of banking, and we're going to go back 90 years and what happened 90 years ago, almost to the day, which was a very big banking, a lot of excitement, a very big banking scare back in 1933. We're going to go over that, and we're going to talk about what's happening on the job market and how things are responding. We're going to also talk about the National Association of Realtors just published February results. As you guys know that are following the real estate market, everything's backward-looking data, but the data is in, and we have February numbers. We're going to go over it, see what is happening nationwide, broken down into 4 regions, and so we're going to bring you up to date. But before we do that, let's meet our guest. He is a guy that needs no introduction, but I'm going to, because if you guys don't know who he has a real estate, he has a sort of like a financial market YouTube channel, and we'll let him explain it to you. He is from Canada, Luke Smith. Luke, welcome to our Tuesday Night Podcast. Tell everyone a little bit about you.
Oh, that's my wrong channel, by the way. It's the Market Mania one. But yeah, so basically I'm a student of psychology. I trade financial markets every day myself, so I'm active in these markets. Thank you so much for having me on this platform, Scott. I'm looking forward to diving into all this stuff. It's crazy times right now, so.
It is crazy times. Why don't you tell us what's happening in the real estate side of things in Calgary?
Yeah, so, Calgary is seeing kind of the migration cycle that Florida and other places in the US are actually seeing. So essentially, a lot of people are moving to Calgary right now because it's a more affordable market, essentially. But historically, this has actually just been another cycle and another pattern that plays out. And essentially, Calgary has like one of the rockiest or most volatile employment markets in the whole of Canada. So it's interesting to see that trend. But I really, as somebody who reads a lot into psychology, I really think this is more psychological. It's a lot of that fear of missing out, which is just chasing any possible avenue it can to get into the real estate market.
Yeah, we were talking too, Luke, with the psychology of things, and there are the string pullers, right? The ones that want to, kind of use mainstream media to, kind of make us panic, and exactly what you're saying, make kind of create the fear of missing out, create the panic, and kind of direct us and guide us into almost behavior patterns. And so we know a lot of that is happening right now. There has been a lot of panic in the marketplace. But before we dive in, Melissa.
Hello. How are you?
I know everybody knows who you are. But why don't you just tell everybody?
Yep, I will.
Again,
and for
remind
those
them.
who don't, so I am Todd's assistant here at Sachs Realty, and it's a pleasure to be here every Tuesday night with you. And Luke, so happy you are our guest tonight. It's wonderful to meet you in person. And a lot to go over this week. This is a heavy week. We've got the Fed meeting, as Todd just mentioned. We're going over a lot of information. Hopefully we can fit it all into the show. But you guys, I see your comments and questions. Please keep them coming. I'm going to be filtering them through to Todd and Luke, and looking forward to another awesome Tuesday night.
Well, I'd like to start out tonight with what is going on in the job market, because as the Fed has been raising rate, the goal has been to cool down demand, buyer demand. And we know what happens when buyer demand cools down. History has told us that unemployment rates rise. And I want to just go over some, top news right now because Amazon just announced another 9,000 corporate layoffs. And that includes corporate and tech workers by the end of April. And they've already laid off about 18,000 employees I think it was November, around that time. Google Alphabet is cutting 12,000 jobs. That's right, 12,000 jobs. Microsoft to lay off 10,000 workers. This is all brand new stuff in the news. Dell is eliminating about 6,500 workers. Zoom, we all know Zoom because what happened was when the pandemic hit, everybody went to this stuff, streaming. Zoom lays off 15% of its entire company, or about 1,300 jobs. And Meta, which is Facebook, plans to lay off another 10,000, roughly 13% of its workforce. And here's the big thing, guys. They are closing 5,000 job postings. And, every time I hear about these job postings, all this hundreds of thousands of available jobs that are out there, I wonder when I see somebody like Meta that is laying off 10,000 or 13% of its staff, and all of a sudden now they're going to close 5,000 job openings. That makes me wonder, were they even real? And Salesforce, we all know who that is. They are a big, CRM type of software company. They are laying off about 10% of its staff. So with all of this unemployment in the news, that's not even counting the mom and pop shops across the country that are feeling the squeeze of Jerome Powell's rate hikes. And we know that it's necessary. And Luke, maybe, kind of you follow the U.S. market. I mean, what's your take on all that?
Yeah, I mean, the economy is starting to deteriorate. We've already seen what has happened with the banking crisis, and I really just believe that's the start. We've had the yield curve that's been inverted since last year, and essentially that's just the large pools of money in the bond market predicting something bad is coming, predicting inflation is going to come down, but not telling us why that's going to happen. So I've been kind of here expecting something to break at some point, and it certainly seems that we're at the start of that. And then all these companies, especially Amazon, Todd, I mean, Amazon is kind of like a bellwether for the economy. Amazon is one of the biggest companies in the US. And if Amazon is laying people off, I believe that is really profound and something that we have to take note of. It might not be necessarily the jobs, but I think when I was looking over the course of the pandemic and everything that happened, they hired a ton of workers. And are we now going to see all those workers come back to the market? I don't remember the exact numbers, but I think it was over 250,000 people. So you're talking about huge numbers that could come in, and it's just showing us that consumers are strained, and that is not a good thing. It's a good predictor of where the economy is heading, which is potential recession. We've already had the 2 negative quarters of GDP, and they redefined the word recession over it.
It is. It's laughable. It's a joke, really. I mean, it's, just goes along with that whole, macroeconomic scale of using, emotion to kind of confuse us, right? And for those that don't know, I mean, you don't know any better, right? They say we're not in a recession. So unless you're studying this stuff and kind of understand what the term recession, what it has meant historically, but let's just kind of talk about some of the real estate that's in the news, because, a lot of my audience wants to know what is going on with real estate. There's a lot of buyers sitting on the sidelines. Now we're getting conflicting data where they're saying, hey, we had a uptick in sales to end 12 months of decline in numbers, right? Sales numbers. So that kind of makes people think, well, the housing market is going now in the other direction. But unless we kind of identify and look at some of these charts, it's really hard to wrap your head around it. So if you're only listening to mainstream media and you're pulling this data and you're not mining further and digging deeper into the data, you might be tricked into thinking that everything is great. And maybe that's what they want, right? That we can continue this out of control spending and that we can see these home prices not coming down or not adjusting. But the fact of the matter is they are. So let's take a look at this chart right here, because what this chart is indicating, and for the first time in a very, very long time, guys, we are watching U.S. median existing, not new sales, not new construction. This is existing home price change from year over year. And we're now seeing it in the negative, in the decline, that we're now experiencing a year over year median existing home price decline. Now we can look at the spike there and we know that's last year. But really what I want to take you to is the last time that we were in the negative of a year over year decline was after the 2008 crash, housing price crash. So very important slide here to know prices are coming down despite what you're hearing. And then let's talk about the home sales as well, because if we're going to talk about house prices declining, we have to understand why home sales have really declined. So this kind of breaks it down in the price range. Largest year over year sales decline here is by the $250,000 to $500,000 range. And that really is the meat and potatoes of most buyers. I mean, if we look at an average across the country, most buyers are in that $250,000 to $500,000 range. That's a lot of our first time buyers. When we get into, $100,000 to $250,000, a lot of that is distressed inventory. There's not a whole lot of that. So it really depends on how much inventory is in each one of these categories too. But when we're looking at sales dropping the most, it's the first time home buyer that we're seeing. Now we can look at regionally, the breakdown here. The Northeast improved by 4% from January to an annual rate of 520,000 in February. It's still down 25.7% existing home sales from last year. And also the median price is down 4.5%. So when we looked at that chart, it was point something. You see right here, the Northeast is really down 4.5% from year over year. The Midwest is kind of picking up a little bit. So existing home sales grew 13.5% from the previous month of January to an annual rate of 1.9 million in February, but still declining in sales almost 19% from a year ago. And we're seeing that the median price is jumping up 261,200, and it's up 5% from last year. And then we can look at the South. It rebounded in sales 15.9% in February from January to an annual rate of 2.11 million, a 21.3 decrease from the prior year. But the median price increased by 2.7% year over year to 342,000. And then finally in the West, existing home sales rocketed 19.4% in February. But here's the thing, guys, you got to remember the price down 5.6%. And, a lot of the West, they're just getting hammered right now. So they have a lot of inventory. And so we're seeing sales skyrocketing, but prices declining. And then, we'll talk about for a minute the Realtor Survey, because I always find this very interesting. This is a report that the National Association of Realtors put out. And I want to just kind of go over this slide here that kind of talks about some of the craziness that we're still seeing in the market amongst the home buyers. And really, I want to focus in on the key market indicators on this slide. And median days on the market, February a year ago was 18 days. This is on average nationwide, has jumped up to 34 days. First-time home buyers as a percentage of sales, and this is a big metric, is declining for the first time in a very long time. So, I mean, historically, we've been over 30%. Last year, we saw affordability start to drive down those first-time buyers. But despite home prices still declining, our first-time buyers are still knocked out of the market here. So it's declined to 27%. Sales for non-primary resident in the U.S., 18%. That's almost 1 in 5. That's telling me that investors are still hot and heavy. They are buying up real estate. Sales intended for vacation use, about 5%, pretty consistent with last year. This is really amazing to me, but cash sales, and this would kind of be, kind of go right along hand in hand with investor sales. The cash buyers out there, 28% in February were cash sales. Distressed sales, which is telling us, there is no real foreclosure inventory that's out there. Distressed sales only made up 2%. It did double from last year's 1%, but that's still, pretty crazy. The average number of offers received in February, 2.7 as opposed to 4.8 a year ago. So that's obviously, half, almost. Percentage of properties sold above list price, 24% of those properties still selling over list price, as opposed to 48% a year ago. Half the properties a year ago over list price. And by the way, list price was crazy a year ago. I want to just kind of talk about this real quick and we'll move on. But percentage of buyers who waived inspection contingency. Obviously, these are not buyers that are paying attention, or these are the investors that are showing up, which is not surprising. 22% buyers waiving inspection still. Buyers who waived appraisal contingency, 24%, up 1% from a year ago. Buyers who purchased property based on a virtual tour, showing open house, virtually, 7%, down from 11% a year ago. Buyers are moving out from the cities. I mean, this is, right here, percentage of buyers who purchased in a suburban, small town, rural, or resort area, 86%, still very high, despite a lot of employers calling people back to work. Median days to close jumped down to that 30. It's right around the same. We're seeing that too with the contracts, 30 days to close on the contract. But interestingly enough, percentage of contracts in the last 3 months that were terminated, 6%, down from last year's 8%. And then percent of contracts in the past 3 months that had delayed settlement, again, almost half, 12%. Percentage of contracts with delayed settlement that had appraisal issues, again, half. So we are seeing that prices are declining, and, that's basically what's happening. So real quick recap on that, guys. We are, first-time buyers represented 27% of buyers, down 31% from January, 29% in February. 28% of the buyers had all cash. 57% of the respondents reported that property sold in less than a month. And really, due to lack of housing inventory, the pace of the market and the use of technology, 7% of buyers still bought remotely without physically seeing the home. It's just, Luke, how does that match up with what you're seeing in Canada?
Yeah, it's pretty much the same. Could be a little more extreme. We've seen sales decline like over 50% in most cities now. But then again, the prices were much higher, and the average price too was much higher when compared to income. So it's not a surprise, really.
Yeah. Melissa, let's take some questions.
Yeah, we've got a couple statements here I'd like to start with. We've got Jordan. In the last year, we've had some pretty wild swings in oil prices, house prices, car prices, food prices, and interest rates. If the economy was a car, every warning light would be on right now. We also...
And beeping.
Yes.
And beeping.
And flashing. Yes. And then we've got Jeff M here. I have a question. It's the spring selling season. Shouldn't there be more houses for sale? Because in my market, there ain't. LOL.
Yeah, Jeff, we always appreciate your comments. Absolutely. I mean, we're not seeing the inventory right now. I have a few listings and some that are coming on the market, but mostly what we're looking at is very limited inventory. And the inventory that we are seeing, two things are happening. In the first week, we're seeing all the buyers show up. And then after that, it just tanks. It drops off. If the house doesn't sell in the first week to 2 weeks, within that first week, as people are coming through, they're negotiating during the next week. Once we get beyond 2 weeks, it falls off. Booking appointments for buyers, no showings on the books. Things are really screeching to a halt here locally.
Mm-hmm. We've got Brad has a question here. I need real estate advice. Where are the affordable homes?
Luke, where are the affordable homes?
Yeah, that's a good question. I don't know. It's kind of crazy because even if you look at markets in places like Mexico, I've been analyzing a lot of markets in Central America and also Mexico, and it's even crazy there. The price increases they've seen in areas where expats and people from America and Canada are going have just blown me away. I mean, it's crazy.
Luke, are we going to see the banks, I guess, scare, right? People with money, especially over the $250,000 threshold, that aren't using their cash, because a lot of companies need that much money or more just to make payroll. But are we going to see, the question is, are we going to see this scared money jump into the real estate market and keep these prices stable, keep them from crashing more?
Yeah, I mean, it's certainly possible that that could happen. I think really you can see that consumer sentiment, though, is deteriorating. So I struggle to get a handle on how that could happen, but it could definitely happen. I think what we are seeing, though, is like a lot of people run from the smaller regional banks and go to those bigger banks. And it's funny because I was reading an article just this weekend that kind of explained the wild swings in treasury bond yields that we've seen over the past couple of weeks and we're still seeing. They kind of were pointing to the fact that it was a lot of hedging that was going on from larger banks essentially buying treasury bonds because they were receiving so many new deposits. So they were hedging those deposits with treasury bonds. And that was why we saw so much volatility in the 2-year. I mean, I saw today that the 2-year treasury, it posted its biggest rise in the yield since 2009. And the other day, it was the biggest decline in yield since Black Monday 1987. So those aren't good times. Like, where were we back during both of those times? Not in a good place. So I think people who are, scared and going ahead and making a big purchase like that, it could be a very, very bad decision, just with everything that's going on.
What do you see people doing? I mean, they need to do something with their cash.
Yeah. Well, I think people just sit on it generally in times of crisis, and they don't know what to do.
Well, let me just read you. So there is and we'll get back to a couple more questions here. SSRN, that's Social Science Research Network. It's kind of like a academic paper that it's open source. You can get the information. There was a couple contributors to this, and they wrote an abstract that says that they analyze U.S. banks' asset exposure to a recent rise in the interest rates with implications for financial stability. The U.S. banking system's market value of assets is $2 trillion lower than suggested by their book value of assets accounting for loan portfolios held to maturity. It says market to market, bank assets have declined by an average of 10% across all banks, with the bottom fifth percentile experiencing a decline of 20%. We illustrate that uninsured leverage, for example, uninsured debt assets, is the key to understanding whether these losses would lead to some banks in the U.S. becoming insolvent. And it goes on to say that SVB was the worst capitalized bank. SVB was not the worst capitalized bank, with 10% of banking having lower capitalization than SVB. On the other incentives for an SVB uninsured depositor run, it says that they compute similar incentives for the sample of all U.S. banks, even if only half of uninsured depositors decided to withdraw. Almost 190 banks are at the potential risk of impairment to insured depositors. It says with potentially 300 billion of uninsured depositors at risk, if an uninsured depositor withdrawals cause even small fire sales, substantially more banks are at risk. I think what we've seen over the last week, Bank of America, I think in 3 days got like $15 billion in deposits. And, I don't know what, I think it was either 6 or 8 billion they lost in the last quarter of last year, depositors' money, because of people spending, needing their cash, right? More and more people. And I think that one of the things that we don't realize, which is kind of interesting to me, is that we don't realize the implications of the Fed. I mean, I'm in the housing market, so I think of the Fed raising rates. I've seen what it does to the housing market. It crushed sales. It crushed affordability, because mortgage rates, though they're not directly affected by rising Fed rate, it does kind of go hand in hand because it follows the 10-year treasury, right? So when the government is guaranteeing money in a 10-year treasury, why would somebody invest in a 30-year mortgage? It makes it more risky, and mortgage rates go up. But what I guess we're not realizing is that with the high debt of America, and now credit cards being on average, I think 19%, and high credit card debt, the money's going out of the bank just simply because people can't save any money. So what are your thoughts?
Yeah, I mean, that kind of makes sense with everything that we've seen with credit card debt going so sky high. And really, this whole fiasco with the US banks, it's not just the US banks, it's also Credit Suisse that has been bailed out. And it was the whole world bond market that was essentially, yields were in free fall last week. So this whole SVB Financial, this is just the tip of the iceberg, because if this was just one bank or just a few regional banks in the US, you wouldn't see the bond market in Japan having these massive gyrations, especially when you're talking the minuscule yields that they pay on those bonds. So there's definitely a scare in the system. We just don't know what is going to cause this crisis. But it definitely seems like on the face of it that it's going to be a banking crisis, because we're already seeing it come to fruition. And the Fed raising rates, we've just got to remember here that this has a lag effect. So because I'm really terrible at math, let's just say it's 12 months lag. So we're at 50 basis points since last year. So just think what's going to happen when the pendulum really starts to swing the other way. And the other thing is, and all the mainstream media going on and on about the pivot just drives me insane, because even if they start cutting rates, even if they came out tomorrow and started cutting rates, again, there's a lag with that. So it's not just that they're going to cut rates and everything's going to be fine. The stock market might go up off that because that's the juice that they need, but it's really not a good sign for the economy. I mean, debt is just sky high. And I think the Michigan Consumer Sentiment Report came out the other day, and it was actually reading back down at the lows again. So, I mean, none of this is good news, really. And yeah, it's going to be interesting to see where this heads, but I don't think it goes to a good place.
I think it's interesting. Back in March, almost to the day of SVB collapsing and the FDIC getting involved and, saying, oh, man, we might have a really big problem here, right? I mean, you have 97% of depositors had over $250,000 in the bank. I know personally some companies that were really scared. They, they spent a rough weekend, wondering what they were going to do if it was the end, right? And but interestingly enough, Roosevelt back in 1933 on March 12th, 1933, and I'm going to publish this. If you guys are watching this, or if you circle back around, there is an audio recording, or you could just search for yourself, of Roosevelt addressing the nation at like 10 o'clock at night on the radio because he had closed banks, shut them down for what was known as a bank holiday because people were scared that their money wasn't safe and they were pulling their money out. It was called a bank run, right? I mean, they show up at the bank. It happened just a week ago. I mean, there were lines at ATMs. I mean, people were panicking. They were taking their money out of the bank. We saw the largest transfer from regional banks to these big top four, JP Morgan Chase, Wells Fargo, Bank of America. I mean, they watched billions of dollars coming into their account. It's great for them. I mean, these are also companies that have, a lot of loans, right? They're big lenders. Bank of America, big credit card, lender. So these companies are making tons and tons of money. And now all of a sudden people are like, you know what? And think about this because this is important. As a business owner, transferring your money to another bank is a big deal. It's not coming back. Right? So when you see people transferring their money to these too big to fail, so to speak, banks, these regional banks are screwed. I mean, think about it. We still print checks as a company. So you have to get new checks, new deposit tickets. It's a pain in the neck transferring banks. And you'll stay at a bank because you're disappointed because it's such a pain in the neck. So for all of this money to transfer to these top banks, man, what are we going to, these regional banks, I'm just concerned. But yeah, for an entire week in March 1933, all banking transactions were suspended in an effort to stem bank failures and ultimately restore confidence in the financial system. And you know how they had to do that? They came up with insurance. Let's take some questions. Mm-hmm. Guys, and we're live. We're live. If you're listening right now, you have some comments you'd like to chat in. We'd love to talk with you, answer as many questions as we can. If we don't know, we'll tell you that too.
We have a super chat from Real Estate Mindset. Travis, thank you. How will we get more inventory? In what situation will homeowners with low rates be forced to sell?
Luke, where's Travis, man? Isn't he supposed to be on here?
Yeah, what are you doing, Travis?
What are you doing? We appreciate the super cash, as Melissa wants to say.
That's right.
How will you get more inventory? So look, now the Fed, right? Not the Fed, but FHA. Luke, you know all about this, right? The 40-year mortgage bailout. So, they must expect a lot of people struggling or needing to restructure their loans. when this happened, and VA has had the 40-year, so FHA is just kind of matching that, but they're going to recast the balance. What do you think about that, Luke? They're going to recast a mortgage balance into a 40-year, from a 30-year fixed rate to a 40-year fixed rate loan. We had this remodification back in the '08 crisis, but it wasn't the same product. Basically, they kept a 30-year term, but they spread the payments out over 40 as far as the amortization schedule, and then it ballooned in 30 years, but it didn't work. I mean, the people lost their houses anyway. What do you think about the 40-year mortgage?
Oh, I mean, that's just adding a lot of interest, and essentially it just puts homeowners more at risk, in my opinion, if there's a recession and a real downturn, because if people do start to lose their jobs, that's where you're going to really see that inventory that's hiding right now come to fruition through that. And I think that doing that can be dangerous, because if people have got more interest on their mortgage, it's easier for them to go upside down when housing prices start going down, and then they go to sell and realize, in fact, they are upside down.
This is just amazing to me, right? So we have a struggling homeowner that is in a home. And look, I don't want to see anybody lose their home, right? That's a terrible thing. But there has been, multiple conversations and podcasts and, articles that are written where financial advisors are saying, one of the number one reasons why people do not have proper retirement funds when they get old is because they overspent on a home, right? So it's a lifestyle expense, right? You can't bank on the appreciation of owning a home. You can't bank on it. And you guys, you'll argue with me in the comments on this, but I've seen it too many times, right? People overspending, not doing repairs, not having the money to keep up with the repairs. They need to sell it and they lose their rear end because it's worth less because they couldn't afford to keep up with it. So we see this time and time and time again. But what happens when I see it, because I go in these places, what happens when a borrower falls behind in their mortgage, they default. Either one or two things are happening. They're doing it on purpose, taking advantage of the system, or they can't afford it, right? The ones that can't afford it, which I believe is the majority of these people, they're not fixing their house. So things are declining. The roofs are going bad. The heating and air systems are failing, right? The house is falling apart because we know if you don't keep it up, if you don't have enough money to keep it up, it's going to fall apart. So just by taking someone in default that has been in default for 2 or 3 years, struggling since the onset of the pandemic, or maybe even before, to extend that balance to a 40-year note without a reinspection, without some kind of, are these people going to, are we delaying the inevitable? Somebody's making money here. Somebody's making money, right?
Is that FHA loan? Is that a government insured loan?
It is.
So it's the taxpayer that's eventually going to have to pay for this mess again. Because the funny thing is, Todd, like in most cases, lenders won't want to do 40 years because of the risk involved. But then when the government or some other third-party insurer comes in and goes, we'll insure that, they're like, oh, yeah, okay, takes the risk off the table. But you got to ask that question in the first place. Why don't they want to take the risk on the 40-year loans? Why do they need all these guarantees?
Hey, look, Wall Street liked it the last time the government foreclosed on all the properties.
Yeah.
I mean, they benefited.
Yeah, that's true.
Yeah, they put them in the rental business of single-family houses. So, Travis, where's the inventory coming from? I mean, this is a great question. I mean, we know that there's a lot of starts. We know permits are up on new construction. I don't know. That's a great question. How are people encouraged or enticed to move? They're in the lowest mortgage interest rates in the history of lending, of borrowing. Good, borrowers that are paying their notes that are under 4% or 4% or less for the 30-year fixed rate mortgage. Why in the world would they sell? They've got the best of both worlds in the last decade, right? So their house, they've got plenty of equity. They're not paying a lot for it. They've got a nice house, and their mortgage is cheap. Why would they sell? So, unless we're going to have a big turnover, of older people, there are, things happening to them. They're dying off. Is that where the inventory is going to come from? I don't know. I mean, I really don't know. Maybe their kids will take those houses, scarf them up, and turn them into rentals. We have something else that's a phenomenon that's happened is this Airbnb business. And I made a statement the other day where, I look at him. There he is. Speak of the devil. So look, Airbnb, right? I made a comment on a video that said that there are a lot of people that don't know what Airbnb is. And they're like, I came under fire. People were saying, "Oh, that's crazy. You're ridiculous. What do you mean? Nobody knows what people don't know what Airbnb is." Man, let me tell you something. There are a lot of people that don't know what Airbnb is or have never used it before. In fact, it's about 1 million houses right now currently in short-term rental, VRBO, Airbnb, HomeAway, whatever. There's a couple of them, right? Not plugging them. It's just a fact. You guys can research it yourself. But interestingly enough, is they are hammering the long-term rental market because they're buying these houses up and they're making very little inventory out there for single-family home rentals. Travis, what's up, brother?
Not a lot, man. I'm sorry I'm late. I got stuck in traffic picking up my jacket from the dry cleaning.
Yes.
Well, that's a good excuse. We'll let you slide.
Thank you.
You slid right in. What's going on, man? I thought you were traveling.
I'm preparing. I'm preparing to travel, man. I told you couldn't count on me, but that I would try to make the stream tonight. I had to button up a lot before leaving tomorrow. I'm really excited. I'm going to California. I'm going to check out metro area, San Diego, Orange County, and the Empire, and just try to get some more boots on the ground intel back to the viewers. So really excited, man. And I'm also going to see my son as well. I haven't seen him in years, my oldest son. So super excited, man. Super excited. So it's just a lot to button up, man. I'm really sorry I'm late.
No problem. What's the Fed going to do?
What's the Fed good? You're asking me what the Fed's going to do?
Yeah.
Well, they're going to have us pay for their mistakes in 2019 and 2022. So a lot of people, I think, are afraid of the Fed pivot, right? And I don't think a pause, Todd, is a pivot. I think a pause is a pause to see what's going to happen, because what we saw with the banking crisis is a systematic failure. And I think it's also important to note it wasn't cash withdrawals that crushed that bank. So it was a systematic failure. There's no fraud. It was big companies wire transferring their funds. So it wasn't even a cash liquidity crisis. It was just they didn't have the money crisis, right? So pretty heavy, man. I mean, it is a huge systematic failure. I think they stay the course. I think a quarter point. I think that this systematic failure is going to allow them to take their foot off the gas. I think that he wants to keep his foot on the gas. Powell, he was in Congress right before this happened, but it's going to be interesting to see how much he takes his foot off the gas. There's no way it's a full pivot. There's no way that that's going to happen. I could be wrong. We'll find out tomorrow.
Yeah, I don't think you're wrong at all. I think you're right on, but yeah, we will find out tomorrow. I think we ought to jump on a live stream or something, all of us. Talk about that when it happens, the markets will respond. Melissa, let's take some questions.
hmm We have, let me just backtrack a little bit here. We have 808. Let's talk about the commercial space. We have Ryan, commercial lease signs everywhere. What will happen to commercial properties?
Man, there is a day of reckoning coming on commercial properties. I can tell you. I mean, offices. I think we're going to see a lot of these buildings. Fortunately, for a lot of these building owners that are mortgaged to the top, they're non-recourse loans for many of them, and they can just walk away, and they're going to toss the banks the keys. And we're already seeing where commercial lenders are tightening. I talk to a couple of them quite often. I do a little bit of commercial real estate myself and help clients as well. And we're seeing where banks are wanting 30-35% cash down on these property purchases. They're backing off of them big time. They want owners to be owner occupants. They want them to have, years of positive cash flow financial statements. You're looking at 7% best case scenarios for commercial financing right now. And a lot of these borrowers in the past are on 4 and 4.5% commercial loans. Their loans are going to end. Their terms are ending. The properties are, the assets are empty. So a lot of what they needed to get the loan in the first place, more than 50% occupied, they're really going to be faced with some issues. So the bank is coming to them. Let's just say commercial loans, a lot of them are 5 and 10-year loans. Now they'll amortize them over 20 or 25 years to lower the payment. But what happens is in 5 years or 10 years, those rates are adjusting and they're reanalyzing the asset, the banks. So they're saying, hey, look, they want you to submit your financials every year anyway when you're borrowing commercial money. So every time you do your your tax returns, they want a copy of them. So over the last couple of years, they've gotten hammered, right? A lot of the tenants haven't paid. They're delinquent. They've moved out. They've defaulted. So this space is sitting empty. So now the lender's going, okay, yeah, your loan's due in July. So let's reassess that. Let's send me your P&Ls, your profit and loss statement, and let's take a look at what you have here. And they're going to say to a lot of these landlords, we want more cash down. Your rate's going to double. And they're going to say, well, I don't have it. So I think that we're going to see a lot of this commercial property come up. Maybe the next wave, actually, of opportunities for these investors to come in and really put their cash to work and repurpose these buildings. So I think we're going to see a lot of these office space buildings be reconverted to mixed use and residential apartments. Luke, how about in Canada? Are you going to see that too with the commercials?
I mean, yeah, it's kind of funny because the city I'm in, something like 20, it's the highest rate in Canada for vacant office buildings. The city of Calgary I think it's the highest in North America, actually, including the US. It's absolutely insane, the number. There's actually a tower here that you can go up, and we went up it in 2020 and we just saw to the extent of it because you could see the light coming through all the office buildings and they were just empty. The thing that scares me about the whole commercial real estate situation is there's commercial mortgage-backed securities. This is a huge market, and it's really like what we don't know about that market. Like, have the banks been creating lots of derivative products on top of these commercial mortgage-backed securities that, had a very low probability of paying out? And now the probability has switched completely because of what happened in 2020. And that's what we kind of don't know. But if I was to put money on what I think is going to be the black swan event or what could be the major crisis that hits, I would actually put money on commercial real estate and it's something all of us can see driving around wherever we are. We can see empty buildings everywhere. And I've said for the longest time that somebody is paying for that and somebody's going to end up paying for that. and it'll probably be the taxpayer, no doubt.
In Calgary, Luke, are a lot of employees still working from home?
Not really anymore. So a lot of return to the office. But Calgary kind of suffered due to in 2015 when oil prices went down. It's a very energy dependent economy. It's also commodities as well. And just due to the government and kind of political environment, even though oil prices went really high last year, there's been a lack of investment. I'm sure Travis knows about that because he's in Texas, and similar sort of things happen there in the major centers because they're big oil cities as well. So yeah, like a lot of people are returning to the office, even the government. They're always the last one. No surprises there to let people back, well, to say come back to the office. So that's happening now. But still, so much of it sits vacant. And, you know, this is what people can really look at, which is in their backyard and say, you know what, this kind of sums up the economy, and it sums up what the governments did all around the world, the US, Canada, the UK, in Europe, was they pumped all this money into the system. But did it fix things? No, it just put a Band-Aid on it. And it's like the Fed is doing right now with these banks. They've come out with this bank term funding program before, and that was in 2007. December 2007 was when it came out with that program. So, you know, these are just putting a Band-Aid. They're not long-term solutions. And we have obviously major issues that are happening in the financial system, and we just don't know what it is. You know, it's like our good friend Scott Walters said, throw a dart at an economic, you know, dartboard. And there's so many different things on there right now. It's hard to pinpoint which one.
Yeah. Travis, what are you seeing in your market?
You know, I guess just what everyone else is seeing in their market, you know, with specifically with commercial properties. I see building all over the place in my market, but that's to be expected in Texas. Texas is the #1 state of building. So, I mean, honestly, man, within a 10-mile radius, there's new commercial construction, not residential, but commercial, and even commercial residential all over the place. But the vacancy rate is through the roof. They can, you know, the builders are continuing to build at historic rates on top of the vacancy rate, right, being historical. And I think that you guys are, you know, I agree with a lot of what you guys are saying. And I look at commercial mortgage-backed securities as the new subprime crisis. You know, because of the lack of lending standards, the non-recourse. And really what I see is if they can't fill these properties up enough, if the vacancy rate is too high, and when they go to refinance, because like you were saying, the unfavorable financing potentially balloon, they have to refinance. If they go to refinance and there's a big pocket coming up around August, according to Orlando, right? If that pocket of commercial, you know, mortgage-backed securities can't qualify anymore, right? They can't even qualify for a loan. I could see, basically what I'm trying to say is I can see inventory coming from that systematic failure. If it's a non-recourse, right, and the lenders take back the property, I can see, quite frankly, I could see the lenders trying to liquidate the property. Then again, I can also see them holding the property as well and writing it out. It just depends how much money they're losing. And what Luke was alluding to is we really have a lot of uncertainty. A lot of people didn't realize that, you know, with the bank failures, that they had so much money tied into assets. There's still assets. It's not like they're buying subprime mortgage-backed securities like in '08. These are like treasuries. A lot of it was treasuries. And, you know, if we find some of these huge BlackRock, Blackstone investors are, you know, have their money tied up in non-performing assets, maybe that's where we get our, you know, additional inventory, you know. So when that starts to collapse, it's going to be very intriguing what we find out. But I'm seeing the construction everywhere in my local housing market, Todd. I'm not seeing it slow down whatsoever, at least in the appearance. I don't see it, but literally everywhere is construction in my market here in Houston, Texas.
Yeah, well, you know, on the commercial side of things, it's not good for areas when these buildings sit vacant. I mean, when we see, you know, vacancy, you know, it definitely will drive areas down. So I think it is something that they have to absorb, that commercial inventory. They can't just let it sit there. I think that we'll see, like I said, a lot of it converted to, I think we'll see a lot of these operators, multifamily operators step in. I think that affordability is going to prevent a lot of people from buying a home. The lack of inventory is going to prevent a lot of people from buying a home. And for people that don't want to move back home with mom and dad, they need to rent. So I think we're going to see a lot of this inventory converted to rentals. And, I don't know, maybe the next wave won't be the dream of home ownership. Maybe the next wave will be, renting and doing something else with your money that's more positive. I mean, maybe there'll, be a lot of opportunity here over the next several years to invest in something. And so, I'm always telling people, just save your money. Don't just kind of watch what you're doing, watch what you're spending your money on, save it. Don't waste it. You never know when you're going to need it. And, you want to look for opportunities. And I think that's what we really need to focus on, being opportunist, being capitalist, and, try and look at a way to turn this crisis that is about to happen. And it's just because of a lot of stupidity, right? I mean, we can't put our finger on any one thing. I can't put my finger on any one thing. If I had to, I would say the Fed dropping the rate to almost zero is probably the worst. And now as a result, and here's the thing, and I mean, I'm not an economist. I mean, Luke, you follow this stuff way more than I do. But it doesn't take a rocket scientist to figure out who's making all the money here. I mean, there's a lot of money being made. Property taxes are through the roof. It's going up. I mean, the government's got a never-ending way of making sure that things are just taking more away from out of our pockets, right? And so when I'm looking at it, I'm going, man, so essentially what happened was we dropped the rates, pricing, everything went through the roof. The taxes, if you just look at sales tax, if you can bump goods and services 100%, you're bumping sales tax 100%, right? So when you look at it so it's like, what are we doing here? Like, where's the incentive? Where's the motivation, right? And so I don't know. I think the system, though, is imploding on itself because you can only do this so long. And as a result, we just print more money. So is that what we're going to do next? Are we printing more money? Is everybody getting bailed out?
Yeah,
Travis?
I mean, it could.
Luke, go ahead.
Yeah, I mean, it could totally happen that way. I don't think it will happen as fast because of what's happened with inflation. Essentially, they don't want to have to get back to that. I think that's what the market is expecting, though, is that they're going to pivot and they're going to go back to printing money. But, when I think of printing money, I don't think of quantitative easing because that's really just the Fed creating bank reserves. And it's whether the banks actually want to lend out and use those reserves that really matters, not what the Fed is doing. As we saw after 2008, quantitative easing happened, but the banks didn't want to lend because they were eating a lot of losses, even with the massive bailouts that happened back then. So I think it's going to be really interesting to see how they kind of get. I think we are at the end. We're seeing this financial system kind of implode on itself. Like you said, Todd, that was great words there. Because I think at the end of the day, when you look at this system and you take that bird's eye view, it's just a Ponzi scheme. To keep this going, we need people to get more and more into debt. But the problem is humans are greedy. So that means that people at the top, they want to take more and more money and they're not passing on wage increases to workers. And this has been a theme for a long, long time now. It's not just a recent phenomenon. It's been going on for 20 plus years. So, when you have that happen, eventually you're going to get to an end point where people can't even afford to pay that debt anymore. And I think we're bumping up against that right now. Little does the Fed realize, because there's lag effects when it comes to all this debt that's in the system. So I really think like the system itself is imploding, like you said. So, yeah, kind of crazy.
And the more now. And the more we take from the more we shut down small business, the more we're going to see that, right? So affordability for the workers, because the small businesses are the ones that are paying the most amount of money.
Exactly. Yeah.
To the bulk of the workers, right?
Yeah, I mean, exactly. Here in Canada, we see that because we've got like monopolies on everything. I mean, it's more of a free market in the US and it's not a free market in the US. Let's just say that. But in Canada, like airlines, it doesn't matter what it is, everything is just in a monopoly of like 2 or 3 companies. And when you have a system like that, that just enables them to get together and dictate whatever the prices are going to be. And it's not fair at all. And the rules that have been created around that have just allowed it to happen because, again, we've just got this greed, which eventually it comes to its end point, which is this whole thing imploding.
Yeah. Travis, you have anything to add to that?
I mean, Luke took all the good stuff, man. I mean, he, the thing is what I was going to say is, I got to be careful, and we'll find out as the months go on, but they're already printing money. They're already printing money. But the thing is we're made to believe it's just a backstop, right? And that they're not going to use those proceeds to continue, like what Luke was saying, lend. If that happens, okay. Maybe what the Fed did, it was the right thing, right? But a lot of us fear that it's the wrong thing. A lot of us, obviously, it appears that it's quantitative easing. It appears it was a bailout. It appears it's going to be paid for the taxpayer because it is going to be paid from us, and that's why everyone's fear. But the main thing here is, as long as they don't inject that back into the economy, causing inflation to get worse, as long as that money is used to prevent additional systematic failure, maybe it's a good thing, right? But the thing is, as far as the money printing, I mean, how much money can you print before there's absolutely no value left in the money? I mean, it's just, I think what is really killing us, guys, and I think about this a lot. The inflation got stuck in the housing market, right? And due to the lack of historical low inventory, even though we have trends heading up, the historical lack of inventory has really put the economy in a serious pickle, if you will, because how do you get those 2% out of the economy? Because they're fixed rate, not like in Europe. They're constantly 5-year loans, right, Luke? 5 or 10-year loans. It's not right.
Yeah, same in Canada, 5-year loans.
So you have to, as a homeowner or a consumer, you adjust with the economy. But here in the US, we're fixed for 30 years. We're done. So again, that's why I threw that question up, that $20 question. I mean, how do you get those guys at the 2%, 3%? How do you get them to sell? I don't know what happened to Luke, but how do you get those to sell? But again, we'll find out soon enough, Todd, and that's what I'm really looking forward to as far as listening to Jerome Powell. Like, is it really a backstop? You know what I mean? Is it just a backstop? Is it for what you guys are saying, preventing additional systematic errors, complete banking crisis? There's Luke. Oh my God, where'd Luke go? But
There he is.
I am skeptical, Todd. I am skeptical.
Yeah. So I agree. I think we're at a quarter point. Tomorrow. I think everybody knows it at this point. I think we would be surprised if anything else happens. Let's take some questions, Melissa.
Mm-hmm. We got Stanley. Do you think the coming foreclosure and new builds would drive down the home price? If you think so, what are the timing of these to hit?
Travis, you want to take that?
Oh, how dare you? Yeah, I'll take this one, man. I hope you get some nuggets of inspiration in my explanation. Some of these questions, and I'm not being disrespectful, I'm just tired. I've been working all day. But some of these questions are really, pretty much every comment requires a lot of like thinking, right? And we think it's okay, but I'm getting too old to think, Todd. I guess is what I'm saying. I'm too old for this. But anyways, absolutely. If we had a foreclosure crisis right now, that's one of the missing ingredients, inventory foreclosure, right? If we had a foreclosure crisis right now, I'm going to tell you that fear is going to spread. It will act as a contagion. It's going to be on every news station, and it will for sure bring down prices. Also, new home building or overexposed builders like in Phoenix, Vegas, Austin areas in Houston, Yes, excessive new home building will also bring down prices because what is happening in my own local housing market here in Houston that I'm tracking is those new home builders are now bringing some of their inventory under resale value. So in order for those used resale houses to compete with the new builds, they will also have to lower their prices. So I'm seeing that happen right now. Now, as far as when is that going to happen? Okay. So as far as the new construction that's already happening, it's going to continue to happen because they're continuing to build new starts, new permits. They're building like crazy. So probably what I'm expecting is like the dead of summer is probably where we're really going to see the impact of overexposed builders like July and August. Now, as far as the foreclosures, couple things people have to understand about the foreclosures. Number one, most important thing is loan modification is proven effective. I believe in loan modification, Todd. I believe in the 40-year mortgage for loan modification because what we have to understand is loan modification is essentially in lieu of foreclosure. So if you do the 40-year loan, you're done. You're done for 7 years. Your credit is going to be trashed. There's lending restrictions on loan modification. So it's not like you could just get a loan modification. You're going to really harm yourself. And the foreclosure process is lagging. But the crazy thing, Todd, I think that the foreclosure crisis, once it hits, is just going to add to the longevity of the crashing. I could see our housing market crashing for 6 years, man. 6 to 10 years. But I think the foreclosure crisis gets bad, like bad. Now that I understand what I understand now, 2025.
Travis, you know I love you, man, but did you say that you were for the 40-year remodification?
Okay, no, I didn't say remodification. I said loan modification, man.
Okay, well, same thing. Loan modification.
But let me explain, man. Let me explain. All right, I lost my house. I lost my house. If you could keep hardworking families in their house by reducing their mortgage payment $300-400, I say give them a helping hand up. That's the only point I'm trying to make there. Now, is it going to be abused, Todd? Yeah, probably be abused. But I'm thinking of those handful of people that could actually benefit from it. That's my point.
Travis, you weren't in the business in 2008, were you?
I started in 2002.
Okay. So what happened when they did the 40-year modification with the 30-year term and they had the balloon payment? Did that work?
Todd. They didn't have loan modification back then, sir. That's origination business. Now, the origination business, right? The front side lending, no. That didn't work at all. It crashed and burned, but also stated income, right? We got to remember there was also stated income.
I'm talking about after 2008. I'm not talking about before 2008.
The loan modifications were trash back then, man. I mean, I was in loan modifications then. It was all fraud. In my opinion, back then, it was all Ponzi scheme. People were just charging loan modification fees up front. I think what I'm saying, though, Todd, is like now it's a little bit different. I'm for it if it's helping people stay in their house, people that deserve to stay in their house. Because again,
I don't want people to be foreclosed on, man. I'm not saying that at all. I'm not saying that, right? But
I know.
Who's making the money on the modifications?
Oh, 100%.
We don't know what it's going to look like. We don't know what it's going to look like yet, right? They're writing, I think, the procedures to it, or the guidelines or whatever. May 8th is when it, I think, takes effect. But I guess the question is, I mean, I know a lot of lenders they're like salivating right now, right? They're saying, "Oh man, this is great. I get to rewrite these loans." I mean, who's going to make the money? And before you came on, the biggest concern that I have is that if people haven't been paying their mortgage payment for 2 or 3 years, they're not fixing their house. And do you know the average savings is like $100 a month?
That's so bad. That's so bad.
I mean, if you look at, let's think about that for a minute. Let's think about that. Their fees to refinance, I mean, unless they're going to be no fees, the interest rates are going to stay the same and bump out to 40 years. I mean, are they going to modify to a higher rate? Well, we don't know, but I tell you what, man, soon as we start to get out of our lips
40-year
concept of a 40-year mortgage.
Yeah.
Give it a couple of years. It's just like the 7-year car loan, man. It's insane.
But the 40-year was around. The 40-year. I mean, the 40 years is an interest-only loan. It's 100% profit for the lender. I don't think it belongs in origination. I just want to make that clear. I do not think. I think that would be kicking the can down the curb. It would be adding to the inflation. A 40-year on the origination side is a bad idea, in my opinion. But I hear you on the foreclosure.
We're whetting
thing.
the appetite. We're wetting the appetite.
I know.
Appetite.
I gotta lean towards protecting the people from foreclosure. I'm biased, man. I lost everything. I'm always gonna lean towards that side. I'm sorry. Don't hate me, Luke. I think Luke is hating me. I could sense it. You hating on me, Luke? Or are you good?
I think it's Melissa. I don't think it's Luke. I think it was Melissa.
Well, I just want to say it's such a minimal savings. I mean, we're going to see, as Todd said, we'll see what happens when everything goes into effect in May. But if you're only saving such a minimal amount every month, I mean, I don't know. It's unfortunate. I would never want, as Todd said, anyone to lose their home. I think it would be terrible. But then you have to look at, is this really going to be the best decision?
Yeah, I don't, the worst thing in the world, and I have seen it happen time and time again, right? And I've, watched people get evicted out of their houses. It's awful. I mean, it's probably one of the worst things that you can, witness happening. But I will say, I knew a guy that was an IRS agent, and he used to go out when people fell behind in their payroll taxes. Okay, employers, and they would fall behind in payroll taxes and actually spend the employees' taxes, and that's actually a criminal offense because it's not their money, right? It's the employees' money when you're taking money out. And, I was talking with him and he said one of the worst things that he had to do was shut businesses down.
Yeah.
Because they couldn't manage their money. And he said, as hard as it was, there was an amazing amount of people that thanked him. Okay. Because when you get to a point to where you just sometimes a reset is what we need.
I agree.
Right? You can't have 12th place ribbons for everybody. Yeah. At one point, you have to tell your kid they can't sing before the world tells them that they can't sing. Right? I know you love playing soccer, but you're never going to make it. At some point, we have to be honest and say, guys, we have to get back to what's really important. And, some of these people that made buying decisions would be relieved. They don't know it yet, but they would be relieved if they could start again. We put too much pressure on people. You have to have this. You have to do this, or you're not adequate. And that's not right. It's not true. It's okay to rent. It's okay to not buy a house. We have to start realizing what's important here in life. And debt is just killing people, stressing them out. Sometimes you just have to say, you know what? I need to just cut it. I need to just cut it and start over. And I'm not telling people to go bankrupt and to get foreclosed on and things like that, but sometimes that might be necessary.
It's a debt trap. I mean, when I went foreclosed and I went bankrupt, I didn't even stay in my house for like the 3 years that I could have, because it was in California. You could stay in there like for 3 years. I stayed in my house for 2 weeks. I filed bankruptcy and I was like, boom, done. Time to start over.
How did you feel when it was all said and done?
So here's the thing. I felt two ways. At first, it was that immediate gratification. Like, thank God I don't have people trying to sue me for the overwhelming credit card debt that I had. But the other part of me, once that honeymoon phase faded away and I realized that's going to take a tremendous amount of effort for me to get my things back, I was depressed for a long time, because there was buying opportunities for the next 3 years and I was forced to the sideline with bad credit, with no income. Right.
And let me ask you, whose responsibility was it in the first place?
100% mine, man. 100% my responsibility. 100%. And people are making bad decisions, and I'm not taking away from people need to make their own mind up when it comes to buying the house. I'm only saying that there are some people that could possibly benefit. Now, if they're re-regulating 40-year loan modifications and making it easier to get, that could be a problem, because they already have 40-year loan mods right now, but you have to qualify. So there's a qualification, right? So I need to know more about it, Todd. It's just a bad situation, man. I mean,
Yeah.
they're going to have to pay for the bad decisions, and that's just the way life works. And that's your point, and I agree with it as well.
And look, I'm not happy about it either, but I think we are in a society right now where we're just expectant on bailouts. We're expectant on something needs to be done. We need to have something. I made a bad decision and I don't want to pay for it.
Yeah.
Now look, there are people on the flip side of that went through, it wasn't their fault.
Yeah.
Right.
Yeah.
But we have to look at this thing from a practicality. I mean, a lot of people that bought houses in the last 2 years, man, they should not have bought. Period.
Did you buy a house, Luke? Do you own a house, Luke? Out of curiosity?
No. So I don't own. I'm looking to buy though and invest, but not at this point and I'm not looking to invest in Canada either. I'm looking at markets in Central America and possibly Mexico, depending on how things go there. I think there's going to be an opportunity there just because of the Airbnb fiasco. And I mean, like the boots on the ground research I've done about that is just baffling. It's absolutely baffling. I mean, the stories I've heard, the things I've seen, just nobody taking responsibility for any kind of risk taking. And I think this is where FOMO kind of stems from, in my opinion. Like when I'm making a trade in financial markets, I accept the loss before I place that trade, because if I don't, then I can get FOMO. I'm at the whim of my emotions. I need to be 100% accountable for what I do. And that's what I've seen like across this Airbnb fiasco is zero accountability. Nobody even asking like, what if the builder, like buying pre-construction in Mexico, nobody asked what if the builder goes under or anything like that. What about buying in this trust? What are the risks associated with that? Nobody's asking. I went to a host meetup in Cabo, and that was just like, that was just eye-opening to see the type of people that are buying these Airbnbs. And these were super hosts. It was a super host meetup. And I just said, like, I'm looking to invest in Airbnb. I want to come along and chat to people. So they let me go there. And I was just blown away. People from Canada, lots of people from Canada, lots of people from the US too, particularly California, with tech jobs who are working remotely. And I even asked them directly, like a lot of them, I said, what if they call you back? What if you lose your job? And they're just like, that's not going to happen. Tech is tech. You can just move around. You don't understand it. It's not your thing. And I was just kind of blown away by what I saw. And I think this presents an opportunity for people who are looking to invest in that type of thing in the future, because I think there's going to be a hell of a lot of distressed Airbnbs selling, because quite frankly, these are the riskiest assets that potentially people are holding, and they're the things that they're going to liquidate. If it's between their own home back in America or Canada, they're going to liquidate that Airbnb in Mexico for sure.
Yeah. And Luke, so you're thinking that it's more important to buy an investment property than it is to buy your own residence to live in?
Yeah, so I don't even, like, I know a lot of successful entrepreneurs and they rent, and I don't even want to own a home, to be honest with you, Todd, because I want to be able to move around. I don't want to have that responsibility. If we want to go from Panama and then live in Costa Rica for 6 months, if we're renting, we can just do that. But if we own a home, there's no chance at all. And the same goes even if you're in Canada or the US. Like, if you buy a home, you're making a huge commitment to that local area that you're in, because potentially you could not be able to sell that home, and that could be the environment for a lot of people who bought in 2021, which could cause this inventory to come out. But those people, like, they could end up stuck. Essentially, they're stuck in that house. What happens if they don't like that area? Or
They're stuck in a house for 40 years now.
Yeah, exactly. Till they're 6. Well, yeah, like it's 70. I mean, oh, that is just ridiculous. Yeah, 40 years. They've tried that in Canada too, the 40-year mortgage, and it was a total disaster.
Well, and look, Travis, I love you, brother. That 40-year mortgage, though, I'm not going to let you alone with that one. So let me talk about the 40-year mortgage just another 2 minutes, and then I'm going to turn it over to you, because I know that you're doing pretty daggone well right now. You came through a downturn, and it made you stronger. You learned a lot by it, and you're crushing it right now, right? You're making a lot of great decisions, which is what happens to people when they go through hard times and they go through adversity. When they're smart, okay, we make bad decisions, and that happens to us, right? But we're resilient and we bounce back. But let me just continue my analogy of the 40-year mortgage payment. Okay,
all right.
Most people are very bad at saving money. Would you agree with that? Does everybody pretty much agree with that? I mean, most people are bad at saving money. Now, it may just be because they don't make enough money. And fair enough, right? And the prices are outrageous. Fair enough. But then they finally buy a house, right? And they stay in that house for 10 years. And the nice thing about when they finance a 30-year mortgage, not a 40-year mortgage, is that they stay in that house in 10 years. They get to a point to where they make that monthly payment every month, and it turns into a savings account, regardless of the appreciation of their home, right? Because they finally get to a point to where they're paying more principal, right? They get to the point it's front loaded, right? We get a payment of $3,000 a month. When you buy that house, almost all of its interest. It takes years before you start to actually buy down the principal, the balance, right? Unless you're lucky to make extra payments, which a lot of people don't do. What my concern is, the 40-year mortgage now, in 10 years, these people will not have money to sell that house and have a savings account that's above. If their home doesn't appreciate much, it only goes up 10 or 15, 20%. And now they want to buy something, move up because their family's grown, whatever. They want to buy something bigger, maybe relocate. Now, when they sell, they have no savings account from buying down their principal on their loan. That's another thing I'm scared about with this 40-year mortgage. People will be stuck. They will be stuck. We will be saving them. If we're lucky, we will be saving them, and we will be planting them right there in that house, and they will be stuck. More people will be stuck than not. And just like Luke said, people are going to learn from this. The young generations coming up are going to say, like, why the hell do I want that? Why do I want to be stuck? I might want to move. I might work remotely. I may want to change jobs. I may want to do this or that and whatever. And I can rent a house, and I'm about ownership. But these younger people are looking at it going, man, well, I don't want to fix this. House is deteriorating. I just bought it. It's breaking down. I want to pick up the phone and say, hey, look, my heating and air system is not turning on. Send me somebody. I think we're going to see more of that. All right, Travis, your turn.
Hey, man. First of all, the number one thing that you have to realize, Todd, is I love you too. Now, I want to be clear, dude. Like, I think that putting 40-year amortized loans in the origination, like upfront origination, would be a huge mistake. And I love how, like, dude, the iron sharpens iron. Like when you were talking, when Luke was talking, the fact that as a society, especially the younger we are, people got to move around. People don't want to be locked into their house right now. People are like on that honeymoon phase, like, yeah, I got a 2 and 3%. But when they need to tap into that equity, they can't tap into that equity unless they play the game like everyone else. So I just wanted to be clear that if they make an origination side, we're not talking a loan mod. If they put the 40-year on the origination side, I think that would be a horrible catastrophe. Not only because all the things that basically because of what you said, you can't build equity on a 40-year until you're like 10, 15 years of a loan. It's essentially an interest only loan. You could have a $2,000 payment, maybe $50 is going towards the principal. So great points there, man. Again, though, on the loan modification side, it's about surviving home ownership. It's not about buying a house. It's about surviving that home ownership. And I learned the hard way, right? And maybe I'm wrong. Maybe these people do need to learn.
Would that have saved you?
Heck no, dude. I needed to learn the hard way. I needed to go through it. I was an egomaniac back then. You would not have liked me in my 20s.
You bought too much house?
I bought too much everything, brother. I bought too much fun was the real problem, to be honest. Anyways, I totally lost my train of thought, but the loan modifications, man, again, I think it's going to help some people, and other people that probably have no business being homeowners are probably going to just milk it for all it's worth. But I'm looking at, a single mom raising 5 kids. She can't save that little bit of $300. But not only that, the loan modification also can help you catch up on what you're behind in. Some people just need that like catch up because they're trapped in debt. Does the problem still exist? Yeah, poor money management, not making enough money, probably trapped in debt. But why? Is it all from poor finance habits? A lot of it. We can all agree, most of it. But also, is it a circumstance from taking care of other people, your sick parents, your children? So, it's just a mess because they never target the people in need. They just throw a blanket of money and they mess everything up. And
I agree with that.
If we can help the actual people in need, Todd, we wouldn't even be in this mess. Like the PPP loans, those were not for everyone, but everyone took the PPP loans.
I didn't take it.
If we could target, my point is, if we could target the actual people in need, we wouldn't have these problems that we have now. But they throw that blanket over everything, and the greedy people are just, let's go, let's loophole this, and let's keep taking money and keep taking money. And you and I and the single mother with 5 kids that just needs a little bit of a hand up, pay. And that's the point. But loan modification is its own thing. 40-year mortgage on the origination side would, in my opinion, that would really continue to make the problem worse, inflation higher, because it's not solving the price inflation. It's just making it appear that it's more affordable because the mortgage payment's lower, when reality is just 100% profit, like you said, to the lender. I'm sorry for rambling. I apologize.
No, it's good. I mean, somebody said to me in a recent comment, they said, why don't you get somebody that disagrees with something that you said? Well, that's what I did. I brought Travis in here. So
Hey, I'm going to tell you, why is it just me? You want to know what I disagree with? I disagree with what you're wearing. Why are Melissa and I the only one with the jackets? And where's my man?
We're keeping you on one side of the screen. All right. So
where's my jacket?
We got the jackets going on. We got, the Sachs jackets on the other side. So
where's Luke's
man, this has been fun. Melissa, let's take a couple questions before we sign off. Guys, we love you. We are live. We appreciate you. We're friends here on the screen too, Travis and Luke. We talk to each other weekly through the week, constantly updating, having fun, being serious, and we support each other because we know we're just trying to do a great service for you. And believe me, it's we've all had our ups and downs, our downturns. I'd lived through it myself. I mean, life has been challenging. Owning a business, stepping out, raising a family. I mean, it has not been easy. There have been times, economic hardship has hit me. I can remember, many times, wondering how I would make payroll or make the next payments and things like that. I mean, it's, hard times are real, but, I believe in resilience. I believe that people stick together. I believe that we're a nation of great people. And, I think that, during these hard times, we can learn from it. We will come out of it. All this stuff that we say here, we're not trying to cause hysteria. We're trying to bring everybody together, and we're trying to make everybody realize that, look, sometimes we have to reel it in, right? Sometimes we have to have these hard conversations, these hard talks, and realize that we can't just make bad decisions and not have consequence. And I think that is what, we're struggling with right now with bailouts is, and even as high as the banks, you can say, should these banks be bailed out? If you go back and you look at AIG back in the day in 2008, and you look at the bailouts, and these people had parties, they gave bonuses to each other, took vacations, they celebrated their bailouts. And I think that we look at that and we're rewarding everybody no matter what their behavior is. Not everybody, we're picking and choosing. And, I think we need to trust the people more, give more reliability and responsibility into the people that are making decisions with their day-to-day lives. So let's take a couple questions.
Well said, Todd. Well said.
That's
We
good.
got Sam Bay here. Would it be a good idea to cash out, refinance in order to build a second dwelling, 1,200 square feet ADU in the backyard? Since financial turmoil like this, should we do that? This is talking about the Los Angeles market specifically.
This is going to be a big conversation with a lot of people because ADUs are trying to make their way in all of the states across the country. In California, I think Washington, maybe Oregon. I know here locally in Maryland, DC, ADUs have passed. Locally here in Maryland, Montgomery County allows for ADUs. That's an accessory dwelling unit. It's basically giving somebody the ability to have a rental at their property. A lot of what I have seen in the lulls with the ADUs is this is not designed for landlords. Okay. This is designed for owner occupants, people that own their home, the in-law suite that we used to refer to accessory dwelling unit in the house. An in-law type of suite is, technically was created for a blood relative, right? Not even for a rental in your home. So, where they're going with this is with the affordability issues and the lack of rentals is their legislators and investors are pounding on this. Hey, let's push through these accessory dwelling unit laws. Again, they're not meant for investors of what I've seen. So the idea here is you have a house, you have a detached garage. Can you convert that garage into an apartment? And so in an area where this is allowed, probably so. Or can you convert part of your house to an accessory dwelling unit, or could you build something? Now, this is a good question because he's talking about wiping out the equity in the home, to grab that cash in a time where this type of cash is expensive, right? HELOCs, home equity line of credit, very expensive right now because it's a fluctuating rate. But I would think, and we'll let Travis chime in on this, but I mean, you really need to analyze the upside to this. First of all, most people don't know how to build anything or hire contractors to do stuff and how much the costs are. And there's a threat or risk of overruns, but also vacancy rates. If you don't rent that thing now is going to put you in a position where your monthly payment is more expensive. So depending on how quickly you can rent it, whether it makes sense, whether the rent is going to return to you a cash flow or not, or knock down your principal mortgage payment would be a big question that you should analyze financially. But Travis, you're a lender. What's your opinion?
I think that we're missing a ton of information from the question. My first question, if he would to call me as an example, would be what is his current interest rate? Because he's saying cash out refinance, a total cash out refinance, which means refinancing the existing first lien. So first I'll say is if you have anything under a 4%, I'm going to probably just take that off the table. Probably. Maybe it makes sense. Maybe there's enough cash flow or maybe they have, it's a refinance. So I'm going to just say right off the bat, it's probably not a good idea to refinance the entire amount. Plus there's additional fees and penalties for cash out because it adds additional risk layers to pricing for your rate. But a HELOC is an option. HELOC is also dangerous. Obviously, the interest rate is going to be higher. But the question is, I think really what he's asking is, it's an impossible question. We don't have all the information, but it's super unaffordable in Los Angeles. Can I, if I do this, I can make $1,500 extra. That's going to help out a lot. Should I do it? But which would be good. If some depending on the situation, if people could handle that, what is a ADU? We don't have that really here around here. Put an ADU in their backyard. It helps offset some expenses. In my opinion, that's probably something that you should look into very cautiously. I would say my primary areas of concern would be being stuck with angry tenants. I have a family. I wouldn't want to do that. Some people don't have children, and maybe that's okay, but it would be the angry tenants. And then also, well, basically crack down on short-term investing, Airbnb. Will that affect those primary because it sounds like, Todd, and I don't know a lot, it sounds like they're taking advantage of loopholes, and it's all fun and games taking advantage of loopholes until they take the loopholes away. And so therefore, and then again, in doing a HELOC, that could be a 30-year mortgage. If you can't rent it out or the law changes, you still, like you said, you still have that expense every month. So if it's me, I'm going to do it very cautiously. I think it would be a different conversation 2 years ago, when rates were lower.
Luke, you have anything to add to that?
Not really, but I've actually stayed in an ADU in my city when we first moved here. It was Airbnb, short-term rental, like Travis said. So yeah, but I really would be thinking, like, do I want to be a potential landlord in a recession? Because that would be the thing that is highest probability on my mind.
Yeah. And, I am a landlord. So, and I've been a landlord for over 25 years. And I can tell you it's a whole business in itself, keeping happy tenants. I mean, just like Travis said, you want somebody that's going to stay there and pay your bill, and you need to take care of them. And, but for a lot of people, I think they're looking at this to add an ADU as an investor and, not as a primary resident. And just like Travis said, how many people want to have some random person that you don't even know living right there with you? Sometimes it works out great. I know people that do it. I know people that Airbnb. Certain counties and jurisdictions will only allow you to Airbnb now if it's in your primary residence. And, I have a friend of mine that did this quite a bit in his condo. He would have somebody come and stay with him for days and weeks at a time that he didn't even know. I mean, I wouldn't want to sleep like that, every single, day having a stranger in my house. So I think that, there's a lot to consider with this. I think the government is thinking that this is going to be a cure-all to the housing crisis. I mean, let's face it, guys, they don't want to chop down trees. And if they do, they want you to, pay a lot of money to reforest other areas, and stormwater management is a big cost. And that's the red tape that these builders are going through. I personally think they're trying to push everybody to rentals. I think, and I'm not trying to be, into the conspiracy, theory or anything like that. But I think that the unaffordability, the lack of affordability, the issues that we have with home ownership that we've learned most now, I mean, this is coming up on 2 decades. It will be that we're getting spanked on the housing side of things in one way or another, from, really the peak of 2006 to the housing crisis. And then now here we are to, big companies have been fueled investing in these single family houses. They're competing with our homeowners on massive scale. We just saw the recent report that came out, from the National Association of Realtors. What was it? 20, it was something, 20 some percent of these buyers that were non-primary resident, 18%. Sales in February, non-primary resident use as a percentage, 18%, about 19% from a year ago. So I think, more and more people are buying these houses for rentals. We have our younger generation like Luke that doesn't want to be locked down. I mean, I think we're going to see this. So in the long term, ADUs might be a good thing. You might see more people, living in their house to be able to afford it, renting out a portion of it. But time will tell. I think I have a video on this on our channel.
A conspiracy video?
No, it basically talks about, this new subscription-based lifestyle, which is coming
Oh
to
yeah.
fruition. People are like, hey, I don't have to own any furniture. I've got all the amenities that I had in college with a theater room, a pool room, a bar, gym, all these things. Why do I want to own any furniture? And if I want to pack up in a month and go to Chicago from New York, or I want to go to, Tennessee, Nashville, Tennessee, I can pay a subscription every single month at $2,000 a month and live wherever I want. And I don't need any long-term lease even. And I think that is going to be, a real thing.
Could be. I would get a
This is
subscription.
fun, isn't it? This is fun.
I would get a subscription for like my hair. Not, dude, I was doing a live when Luke came on there, and like 30 seconds before the live, my hair started sticking up like straight in the back. But I mean, yeah, man, I had to cancel so many subscriptions, Todd. Like I tell people, like, you got to work on your savings. One of the best ways to work on your savings is to understand how you're spending money. And I found that like my two areas that were shocking, like as far as my expenditures, was going out to eat. And then number two, subscriptions, dude. I must have had 20, I'm a content creator, I'm a cinematographer, so I got like the audio, all these subscriptions, but my gosh. And then how many net do you got? I got Netflix, I got Peacock, I got Hulu, I got ESPN because UFC. I mean, my gosh, how many? I must have an embarrassing amount of subscriptions, and I just canceled half of them. I probably have just as many. It's messed up. Good point.
Right.
Good point.
You're a cord cutter that is tied to subscriptions.
I don't even watch TV.
I don't either. I don't have time for it.
Yeah, I can't even watch it.
And he doesn't either. That's why he's canceled his subscriptions, because he realized that the one show that he watched every month, that Travis had time to watch, he's like, man, I'm paying like $400 a month just to watch that one
and it's
show.
The Office, and I watched The Office over. I must watch The Office.
I love that.
11
so
times
he became his own show.
I mean, dude, hey, and I just want to make a point real quick. I was seeing some of these comments. They're making fun of me. I'm not pushing the 40-year mortgage.
Dude, look,
I'm just explaining the difference in loan modification and
brother.
mortgage.
I know you. I understand why you want it, right?
I don't want the 40-year mortgage. I'm not saying that. I'm not the specificity. I think it would be a huge problem if we have the 40-year mortgage in the origination side. It would be a huge problem. Going on the record, final answered. Melissa, get my back here. No 40-year mortgage. Done. Reset my credibility.
Lord help me when I go on Travis's show. He's gonna light me up, man. He's gonna he's gonna payback, man. He's gonna say, look, man, for all those comments on the 40-year mortgage.
Yeah.
All right, guys, let's take one more question. It's late, man. This is so much fun. Melissa, Joe in the background there. Joe is, our content madman. Joe, we love him. He is with us. He makes this whole thing possible behind the scenes. And I know it's late, guys, and they want to get home here on the East Coast. We are. Yeah, but let's take one more question.
Yeah, we got one more question. We've got Scott Allen here. We have high interest rates should chase away many investors from buying single family homes. Does this theory hold water when bonds provide a 5% return and is easier to liquidate?
Who's going?
All right, who wants that one?
Luke.
Okay. So, I mean, you're seeing it in the real estate investment trust. You're seeing people trying to pull out their money. So it is happening. Like, investors don't want to invest. And I think the real people who are investing now, and I know, Travis, you hate it when I say this, it's the dumb money. It's the dumb money that's coming into the market right now. And it could be people coming in over fear because of the banking system, like Todd said as well. But again, those people are just acting out of emotions. But when you look at these real estate investment trusts, loads of people are trying to pull money out. Blackstone, they had something like 36% of like a massive, I think it was hundreds of billions of dollars real estate investment trust that people were trying to pull out. Now that was commercial, but similar things are happening on the residential real estate investment trusts as well. So people are seeing that they can hold their money in treasuries, whether it's 1 year treasury, 2 year treasury, and get a decent rate of return. And I do think that drives investors away, but it's never going to drive them all away, especially considering the hysteria and the just mania. People went insane in 2021. I mean, Shiba Inu, that coin, just went absolutely parabolic. It was literally on the white paper. It was literally a Ponzi scheme. So, I mean, these are the sort of events we had take place in 2021. So, that's kind of my response to that.
And I'm one of those investors, Todd, so I can't really say anything. I actually tucked my tail between my legs. I took my $35,000 loss in the stock market and closed my Fidelity account. And instead of investing in real estate, I've decided to extend my lease and I've bought bonds. So I would say they have a valid point there, because I want to be done with the losing of the money stuff and the losing of sleep and the emotional roller coaster of playing the stock market. So I'm just done. I'm doing the 4-year T-bills laddering up every week.
Yeah. And and this question, as a real estate investor of almost 30 years, I think a lot of it has to do with the experience of the investor too. And whether we're talking about, a institutional buyer or a mom and pop buyer, because, I think that people are fleeing from institutional investors, as Luke had just mentioned, with, wanting to get out of REITs and things like that. And, because they're not the operators and they're watching things like, companies like Open Door that have made very bad purchasing decisions, and they're losing money hand over fist, and their stock is reflective of it. And so when we're looking at but I think that we should really be talking about the ones that are poised the most to take advantage of any kind of a downturn and continue to compete with our homeowners are going to be the investors that have 30, 40, 50 properties, doors, maybe 1,000 doors, which would still, that's a big operator, but not, an institutional buyer necessarily. So I think that these types of buyers are going to be looking for opportunities based on distress. And I think one of the factors that we're missing here is that, there are 3 tiers of buyers in real estate, right? You have a flipper at the bottom of the tier, right? A flipper has to buy at the absolute cheapest because unless they don't know what they're doing, and then they lose money, which happens all the time. But a flipper has to buy it at the absolute lowest because they have to bear the risk of doing a good job. I'm not talking about lipstick on a pig. I'm talking about people that legitimately flip houses. They have to buy at a low price because they need to fix it and make a profit to sell it to either a long-term or short-term investor, rental investor, or a retail buyer. And then the second tier is that long or short-term investor, for a rental purpose. They can pay a little bit more than a flipper, but they still buy a distressed property, something that, the homeowner doesn't buy. So, when we're looking at these single family houses, it really depends on, whether the investors can make money with it based on the interest rates. And that's going to all be about price. How distressed is the house that knocks it out of the market for retail buyers? And, then what is that pool of investor buyers at that point? Because if you get 7-8% on a long-term investment, if you're buying it right, it shouldn't matter. You're buying a payment, and as long as it cash flows, that's what investors are going to buy. And people that like real estate might not like to be strictly in bonds, or maybe they want to be in both, right? So people are in real estate because they love it. They like it. They like to fix houses up. They like to rent houses, and they like to touch the physical asset, go by and see it and wave to it and give it a kiss and all that kind of stuff. So, but anyway, guys, we'll wrap it up tonight. We thank you so much for watching. Luke, my man from Canada, thank you so much for being on tonight.
Thank you for having me on. It's been an honor to be here.
You guys have to check out his real YouTube page, not the first one that we put up. We'll drop the link below. And as always, we love you, Travis. Thank you. Real Estate Mindset, great channel. If you're not already subscribed, subscribe to these guys. Definitely. Travis, thanks for jumping on.
Yes, sir. It's an absolute honor and pleasure, my friend. Sorry I was late, but like I said, traffic, I had to get the jacket before I was on here. I'm sorry, man.
Where's your Crash Bro jacket?
Dude, I haven't made the Crash Bro. You know what? And I can't believe we didn't talk about that at all on this podcast. We didn't talk about the Crash Bros. But dude, I've had so many people, Travis, the cups, the mugs, the this. And honestly, Todd, like, and I could do so much different with the channel at Real Estate Mindset, make it a lot cleaner, a lot more organized, a lot easier for viewers to communicate and all these types of stuff like you do. And it's very, very beautiful. But like, man, right now, I'm going to just be honest. I'm more worried about what's going to happen next, right? I'm walking this out myself. So, and also the other thing, Todd, the very, very important thing is I totally lost my train of thought right now and I'm just treading water. So that's how I'd like to end.
All right. Melissa.
Thank you, Luke. Thank you for being on our show. We'll have to have you back again. This was a pleasure. And Travis, again, you're always so awesome to have on here, and safe travels tomorrow. And thank you, Todd. Again, another awesome Tuesday night.
Well, we appreciate you guys, everyone. And guys, we will be picking up what the Fed puts out tomorrow. So look for that. We're all waiting anxiously to see. The markets will respond. The housing market will respond. And so will the banks. So until next time, guys, we'll see you soon.